Recording in progress.
Hello, welcome guys to today's webinar, and we are in the chapter 3 of the taking advantage of your trades with the Gold Mega Leverage Zetradex is currently offering to its clients, and we are urging every customer to take advantage of this offer and make sure they are able to maximize their profit potentials from trading with us. So it's ideal that follow in suit with everything we're saying and always have perfect understanding about the financial markets first, demo tests, or with a couple of funds, and you are able to understand the strategies and make sure you use it in taking advantage of the Gold Mega Leverage. So without much to say, let's kickstart for the day. So if you are a gold trader, it's very important that you follow and suit these strategies and make them priorities for to be able to make consistent profits from the financial markets using these strategies, of course. So speaking of gold, XAUSD gold, we have been trading sequentially on the gold markets recently, and we have been racking lots and lots of profits, and it's been a bit of a scare to some people who are just new in trading gold, and but I think with the whole arrangements of how to make a strategy out of gold, a lot of people have been excelling, and if you have not been joining us in this, it's ideal and beneficial for you to register, open an account, have some money funded, and pay attention to our gold signals and make money with us. Also apply for the 500 times leverage. So first we'll be talking about what is leverage in gold trading. Now, leverage in gold trading allows traders to control larger positions with a smaller amount of money, smaller amount of capital. By borrowing money from a broker, traders can amplify their exposure to trade gold price movements without needing the full value position upfront. For example, with a leverage ratio of 50-1, a trader only needs to deposit $1,000 for a $50,000 position in gold. Now, leverage is a double-edged sword. While it increases profit potential, it also significantly magnifies the losses. Now, traders must understand how leverage works and implement appropriate risk management strategies to protect their investments, of course. So it's very ideal that we have these things in check and understand how it works. Next page, please. Next page, please. The next page. So first we'll be talking about efficient use of capital. Leverage allows traders to free up capital to other investment opportunities while maintaining gold exposure. Instead of trying to, up a large portion of your funds in a single position, you can use a fraction of your capital to control the same trade size. This efficient use of capital enables portfolio diversification, and as a trader, you can allocate the freed up funds to other assets or strategies. Now, for instance, rather than investing $100,000 in gold outright, a trader could use $10,000 in margin with 10:1 leverage to gain the same exposure, and hence leaving the remaining $90,000 available for other trades. So this is more or less the best and efficient use of the capital when it comes to trading gold on the financial market. Next page, please. Now, you also need to have an understanding of access to larger position sizes. Leverage allows traders to take more prominent positions in gold. So when you're trading gold, you are allowed to take more and more prominent positions than they could with their average capital alone. So this is particularly beneficial in gold trading, where price movements are relatively small and they are said to be controlling a more significant position, which means that even small percentage moves in the price of gold and can result in meaningful gains. So for example, leverage makes this possible if a trader has $5,000 in capital, right? But wants to trade $50,000 worth of gold. Now, the ability to take larger positions allows traders to capitalize more effectively on gold's price fluctuations. So it's very ideal to be able to understand these things and know how it works. All right, next page, please. Now we talk about hedging opportunities. Leverage can also be used strategically to hedge against risk in other investments. For example, if a trader has substantial holdings in foreign currencies or stocks, they might use leverage to open a gold position as a hedge against potential losses in those other assets. Now, since gold often moves in a least expected way or in a volatile way, as per se, it's inversely to the US dollar and other currencies, and it can serve as an effective tool for risk mitigation. You might be wondering what risk mitigation is. So it's more or less like using leverage. You have traders who can implement hedging strategies without needing to allocate large amounts of capital, which then makes it easier to balance risk across their entire portfolio. So that is just basically what hedging opportunities is talking all about. Next page, please. Now, same way we have advantages of leverage in gold trading, it also comes with its disadvantages. And here we'll be talking about magnified losses. While leverage increases profits potential, it also magnifies the losses. Now, a small adverse move in gold's price can lead to a substantial loss or substantial losses relative to the initial margin invested. Now, for instance, if you're using 50-to-1 leverage and gold prices move against you by just 2% of your entire margin, it could of course be wiped out, resulting in, let's say, 100% loss. Now, it's very essential to remember that just as leverage can amplify gains, it can also amplify losses. And this makes leverage trading risky for those who do not have a well-defined risk management strategy. Okay, next page, please. Next page, please. Margin calls. Now, margin calls are very, very important and vital when making gold trading decisions, because one of the biggest risks that has been associated with receiving a margin call. Now, a margin call occurs when the value of your leverage position falls below the required maintenance margin level. And if this happens, the broker will require you to deposit additional funds to keep the position very open. So if you fail to meet the margin call, the broker may close your positions and potentially locking in significant losses. So this can happen rapidly during volatile periods, while making margin calls a constant risk for leveraged traders. So it's ideal that we understand these things personally and understand how it works totally. All right, next page, please. Psychological pressure. Now, trading with leverage can place significant psychological pressure on traders. The possibility of large gains may lead to overconfidence, while the potential for amplified losses can create anxiety. Now, the combination of emotional highs and lows can lead to impulsive trading decisions, which often result in excessive risk-taking or poorly timed trades. Okay? Now, the psychological strain can be particularly detrimental for inexperienced traders who may or may not have developed the discipline required or needed to manage a leveraged position effectively. Okay. Next page, please. Now we have overnight holding costs, also very essential. This, of course, has an ideology of when you hold leverage positions overnight, you often incur interest rate charges or overnight trading holding costs. We call them, some people call them swap charges. But now these fees can accumulate over time and erode your profits, especially if the trade doesn't move in your favor quickly. So it's important for traders to factor in these costs when calculating potential returns. So as they can significantly impact overall profitability, all right, particularly for a longer term trades, it becomes technical know-how for the trader who imagined profit from his gold trades. You understand? So it's just like knowing of having this understanding that overnight holding costs will possibly bring out poor insight, bring out reduction and loss of funds, which of course is less attractive and less ideal for traders who want to actually make consistent profits from these markets. All right, next page, please. Increased volatility risk. Yes, one important thing about gold, the gold currency here, is it always has this very volatile risks, and this increased volatility risk, highly leveraged positions are more susceptible to rapid fluctuations in gold prices. So gold is known for its volatility, and traders using high levels of leverage may of course find their positions quickly moving against them, and this increased volatility risk will of course make leveraged trading particularly challenging during periods of heightened market uncertainty or economic events that will obviously cause some sharp price swings. So it's best we understand these things this way. Next page, please. Now, managing risk when using leverage. For those who apply for the 500 times leverage, I think when it comes to managing your risks, it is much more minimal. You can just trade with with confidence because you already have the 500 times leverage imputed, or applied for rather. So you are setting your stop loss orders. Is just the only thing you need to do. So one of the most effective ways to manage risk when using leverage is by setting stop loss orders. And the stop loss order automatically closes your position once it reaches a predetermined price level, preventing further losses. And this, of course, ensures that even if the market moves against you, your losses will be limited to a manageable amount. For example, if you enter a leveraged gold trade, you can set a stop loss order 2% below your entry price. If the price of gold drops by 2%, your position will be automatically closed reducing the risk of further losses. Okay, next page, please. Monitoring margin levels. So it's crucial to monitor your margin levels regularly to avoid unexpected margin calls. Monitoring your account balance, position size, margin requirements, all these things help you stay ahead of potential issues. And if your margin level is approaching the maintenance margin, consider either adding more funds or reducing your position size to prevent a margin call. All right, next page, please. Next page, please. Diversifying your portfolio. Now, while your leveraging allows you to control larger positions, it's also important not to overexpose yourself to one asset class, such as gold. Diversifying your portfolio across different assets, such as stocks, currencies, or commodities, can of course reduce the impact of adverse price movements in a single market. And this way, if your gold trade underperforms, your overall portfolio will still have the potential to generate good returns. Okay, so it's ideal you always learn how to diversify your portfolio. Next page, please. When to use leverage in gold trading. Very importantly, leverage should only be used when you have a well-defined strategy and you are comfortable with the risk involved. So traders with a strong understanding of the market trends, price movements are better equipped to use leverage effectively. So additionally, we can confidently say that leveraging can be beneficial in short-term trades where quick market fluctuations can lead to significant profits, and traders should avoid using high levels of leverage during periods of extreme volatility or when they are uncertain about market direction. So instead, leverage is best employed when market conditions are more stable and predictable. Understood? So it's best we understand it in this perspective. All right, next page, please. So that brings us to the end of today's webinar. And I hope we were able to pick up one or two things from this to better understand how this works. So really vouching for you all who have been with us from the day one, chapter 1, down now to chapter 3. I hope you have been having series of testimonies and having good lucky trades so far since after the inception of the webinar. And I will wish you more and more in lucky trades, of course. All right. Now, do have a great day and see you again next week, guys. All right. Cheers.